This visualization shows a deep learning model ingesting millions of financial data points. Modern quantitative finance relies heavily on these architectures, but they repeatedly fail due to catastrophic overconfidence. Feeding raw equity prices into a predictive engine is a structural trap. The daily movements of individual stocks are overwhelmingly dictated by universally tracked macroeconomic forces. For example, the daily price movements of Brazilian energy giant Petrobras are completely dominated by the global price of Brent crude oil. Similarly, the raw returns of BRF-SA, a major protein producer, are strictly tethered to the bulk cost of corn and soy meal. Because these macroeconomic relationships are public knowledge and heavily arbitraged, attempting to extract alpha from these raw returns requires outguessing the entire global consensus on commodity prices. An architecture built to process raw market data is structurally flawed. The informational advantage is zero. In a 2026 working paper from MIT, Marcus Burgo outlines a completely different mathematical architecture. The paper argues that true, exploitable signal resides exclusively in residuals, the faint, idiosyncratic price movements that remain only after all macroeconomic factors are dynamically stripped away. To extract these residuals safely, the system imposes a strict constraint of epistemic humility. As the artificial intelligence expands its variable universe, it is mathematically forced to lower its confidence. Achieving this requires abandoning opaque machine learning models entirely, replacing them with a transparent, 5-layer autonomous inference pipeline. The goal is not deterministic market prediction. The goal is to safely quantify nested uncertainty in an environment defined by incomplete information. The pipeline begins by extracting pure residuals. Static linear regression fails here, because the sensitivity of a stock to macroeconomic forces shifts constantly across different financial regimes. A state space Kalman filter solves this by treating the hedge coefficients as latent variables, allowing them to adaptively walk forward in time as new data arrives. However, a standard Gaussian Kalman filter will violently overreact to the heavy-tailed flash crashes characteristic of emerging markets. This chart plots a volatile equity return line hitting a sudden shock. The score-driven student T extension calculates a weight indicator that drops to near zero, preventing the estimated hedge line from skewing. Iteratively, the system subtracts massive, volatile waveforms representing commodity exposure and market beta. What remains is incredibly pure, but its amplitude is drastically reduced. This mathematically isolated residual is the only valid place to hunt for an informational edge. But its faint nature requires aggressive defense against statistical mirages. Because these residuals are up to 2 orders of magnitude smaller than raw returns, standard predictive models easily hallucinate patterns in the noise. To combat this, every candidate variable must survive a triple validation causality gauntlet. The first layer screens for linear association using cross-correlation. The second proves temporal precedence across rolling windows using Granger causality. The final test is transfer entropy. This is a model-free, information-theoretic measure capable of capturing nonlinear information flows that Granger models miss entirely. In the empirical backtest, localized environmental anomalies, specifically heavy rainfall in the Parana region, survived all 3 tests, proving mathematically to be a leading indicator for protein logistics up to 7 days out. Conversely, massive spikes in Reddit's sentiment volume failed the gauntlet, proving to be synchronous and entirely reactive, holding 0 predictive value. The architecture's primary function is rejection, preventing capital allocation based on compelling yet false narratives. Even validated signals rely on stable behavioral pathways, specifically the delayed reaction time of uninformed retail herds. During exogenous systemic shocks, these behavioral pathways collapse. Cross-asset correlations approach 1.0, and the residual edge is instantly erased. The same structural collapse occurs during severe, localized political upheavals, where normal statistical relationships break down as the herd panics. The framework detects these collapses in real time by running a 2-state Markov switching model alongside a Hurst exponent metric to continuously monitor long-range dependence. By identifying these regime shifts autonomously, the system slashes position sizes and tightens risk parameters before a behavioral panic can compromise the portfolio. Standard predictive engines fall into the point estimate trap. They output a high probability of success while completely ignoring the uncertainty of their own underlying parameters and model structures. This hierarchical tree maps an n-depth Bayesian cascade. It calculates if the base signal is correct by multiplying against confidence nodes for regime and model structures. Because every confidence layer is a fraction less than 1, compounding them forces the final effective probability downward. Theorem 7.2 of the paper proves that as the number of independent data sources approaches infinity, this effective probability exponentially decays. This mathematically enforced self-regulation directly counters machine learning's tendency toward catastrophic overconfidence when fed massive datasets. As the system integrates more application programming interfaces, it becomes more informed, but mathematically it is forced to become more humble. This recursive probability cascade forms the epistemic backbone required for an artificial intelligence to operate safely without human oversight. Once the effective probability is secured, position sizing is strictly bounded by Shannon's channel capacity theorem. The maximum geometric growth rate of capital is directly limited by the mutual information between the actual market outcome and the system's orthogonal data sources. The heavily discounted probability from the Bayesian cascade is plugged straight into the Kelly criterion formula. A fractional multiplier is then applied to account for estimation error and finite investing horizons, resulting in a highly conservative capital allocation. This final step establishes a deterministic chain, translating an abstract idiosyncratic residual into a rigorously quantified trade. Over a 14-month empirical backtest, the architecture achieved significant returns by isolating these idiosyncratic signals and ruthlessly propagating uncertainty through the entire pipeline. But this specific residual edge is fragile, and the mathematics explicitly dictate a physical limit. Scaling capital past optimal thresholds introduces market impact. The execution of massive trades actively destroys the very informational imbalance the system detects. This scaling ceiling is not a failure of the algorithm. It is an unavoidable law of market microstructure. The ultimate contribution of this framework is not a promise of infinite scale. It is a definitive mathematical blueprint for engineering autonomous systems that precisely quantify their own ignorance.